Hey, what's up, guys? Just coming to you with another video. Just wanted to basically share with you guys the different types of life insurance because I know that life insurance can be very, very complicated. There's a million different types of policies and things out there that get sold, and it's kind of confusing, right? You see stuff on social media, a lot of stuff is getting pushed, and it's hard to know what's right for you and your family, right? So today we're gonna settle that once and for all, and we're gonna really explain how different types of life insurance policies work. All right, so let's get into it. So I'm gonna share this whiteboard here with you guys. All right. So essentially, there's three different types of life insurance. There's whole life, there's universal life or IULs, and there's term. All right. Now, all three of these types of life insurance has their own unique use cases. They all have very different things that they're used for, and they all have their own individual pros and cons. All right, so this is something to consider if you are thinking about purchasing life insurance, right? And you're not sure what type to purchase and why. So first, before we even get into it, let's talk about the purpose of life insurance, period. Why do I need to purchase life insurance? Well, if you have anybody who depends on your income, you need life insurance, because life insurance is not just for when to pay for your burial or your funeral costs and things like that. It's also to make sure that the loved ones you leave behind can sustain their level of well-being and their level of income after you leave, because when you leave, the bills don't stop coming in, right? So how are they going to, if you and your wife or your spouse are both making, let's say, $5 grand a month, well, that's 10 grand. So your household bills, in a typical household that makes that much, would go right up to 10 grand. So if you lose half that income, can your surviving spouse pay $10,000 worth of bills with 5 grand? No, they're going to have a challenge, aren't they? They're going to have to downsize, sell the house, have tons of financial distress as well as emotional distress, right? And that's the purpose of life insurance, to negate that, to offset that, to make sure that your loved ones are taken care of long after you leave this earth, typically until your youngest child is 18 to 21. All right. Now you can get fancy and include college education in it and some other things in it. But we're not going to talk about that today. You could do some estate planning things, really specific niche use cases. But for purposes of today, we just want you to come away from this video understanding how different types of policies work. So when the salespeople who come to sell you these products and make a commission off them, you know why they're trying to move you in that direction versus what's in your best interest. Okay, so let's talk about whole life insurance. Now, this is a very common and pervasive type of insurance that gets pushed every day. I'm sure everybody's seen the Colonial Penn commercials, right? Guaranteed insurability, cash value you can borrow against, all those things, right? So let's talk about what's called guaranteed values of whole life insurance, and let's talk about how these products work. So the first thing that we got to understand about how whole life works is that it is savings combined with insurance, right? Savings combined with insurance. Now, what does that mean? So typically, we separate our insurance from our investments, but somebody got real slick and said, what if you could do them, kill two birds with one stone and just fuse them together? right? So whole life, is insurance that bundles with the savings. And people are like, oh my God, that's awesome, because now, I can save money inside the policy, and I can, be able to get it tax free, and it's awesome, right? But you'll see here in a minute why it may not be so awesome. All right. So the second thing about whole life that we need to discuss is that it is much more expensive, right? Because you have that savings account, right? So that savings account is not cheap, because you got mortality costs and you have to have money going towards the savings account, right? The problem though is that savings doesn't start building up for the first 2 or 3 years after you buy the policy, I'm afraid. That's right. So imagine if you went down to a bank, 𝗪𝗡𝗪𝗏, and they said, welcome, Mr. and Mrs. So-and-so. Let me explain to you the way our accounts work. So the first thing is, you're going to open up a checking account with us. You're going to get direct deposit. For the first 3 years of you depositing money with us, you're going to have a zero balance. So after you depositing money for us for 2 to 3 years, you're going to have a zero balance. How excited would you be to open up an account like that off the rip? But wait, we're not done. It gets better. Suppose, okay, you're really going to love this. So once you do start to accumulate money in your account, you got to borrow us and pay us 5 to 8% to get it. How you liking this account so far? And what's the cherry on top is that when you pass away, we don't want you and your family members fighting over the money, so we're just going to keep it. Now just sign right here, and we can get that account open for you. Now, as funny as those rules sound, would you ever open up a bank account that works that way? No, absolutely not. Well, guess what, folks? Those are all funny little rules to illustrate what are essentially written as what's called guaranteed values of whole life insurance. That's exactly how whole life, the savings account in your whole life policy works. And we'll talk about that here a little bit more in a minute. And the thing about that savings is it's not really attractive. And part of the reason why it's not attractive is because the interest paid in it is usually very low, usually between 1% and 3%. Now, here's the thing. If you follow what I teach and you understand how the rule of 72 works, then you should know that's not going to work, right? Because what's, 72 divided by 2%? 36 years, 36. So it's going to take you 36 years for your money to double at 2%. And my question to you is, how many doubling periods of 36 years do you have left in your life? So if you're considering opening up a whole life policy because the savings component is appealing to you, because you can get money out of there and need it whenever you need it, don't do it. Because guess what? You have to borrow your money and pay it back with interest, right? And the interest you do get on your money is very low, and it takes a long time for you to accumulate anything, because especially since, like we just talked about, you don't accumulate any money for the first 2-3 years anyway. All right. The next thing we should talk about is the fact that insurance, doesn't matter what type of insurance policy is, should never be sold as an investment. That's going to be very important here later when we start talking about universal life and IULs. But I just want everybody to know, if you get approached by an agent that comes to you and says, hey, I got this way for you to invest money, and you can, borrow money and you can get money tax-free, they are violating state law. You are not allowed, if you hold an insurance license in any state in the United States, you are not allowed to sell life insurance primarily as an investment plan or strategy. So if anybody tries to sell you life insurance as an investment, run the other way. okay? Because it's not what it's there for. The primary purpose is for insurance. All right. Now, the other thing, like we talked about with those funny banking rules, is that you don't get to keep the death benefit and the cash value, right? So when you die, let's say you have a $100,000 life insurance policy, and that's whole life, and you have accumulated, you've had the policy for 36 years, and you've got 20 grand in there, and your wife's like, I want a new car, honey. And you guys go out and buy a new car, and you pass away the week after you buy that car. Well, guess what? The agent that sold you that policy is not going to deliver a check for $100,000. They're going to deliver a check for, you know, $80,000 minus all the tax, the fees, and the interest that you owe on that $20,000 loan. Because remember, anytime you take money out of that account, it's a loan to you with interest. And if you don't pay it back before you die, it comes out of your death benefit. So now you might be planning on using that $100,000 you bought, but now you're only going to get probably 75 or 60, depending on what the interest rate is. So it's not worth it, right? Do not buy these for an investment or to borrow any money from them. There's a better way to handle that. We'll talk about it here in a little bit, right? And we just talked about this, but I'm going to put it down anyway. If you must borrow your money, there's no other way to do it, to get money out of the policy. And if you don't pay it back, it comes out of your death benefit. I think we just established that. Not good, folks. And certainly not in your best interests to do as a consumer. There's a lot better ways to handle that, right? The other thing about whole life insurance is that it's permanent. It's referred to as permanent insurance, right? Even though it only lasts till the age of 100 and then it endows. So what does that mean? So it means when on your 100th birthday, the life insurance company, the whole life company, will send you a check for whatever your death benefit is, because essentially you've outlived their mortality expectations of you. So you win. Here's your $100,000 or whatever your death benefit is. Have a nice day, right? So those are whole life right there. Insurance and savings bundled together. Low rate of return. You don't get your death benefit and your cash value. You only get the higher of either or. And you have to borrow your money. And if you don't pay it back by the time you die, you got to pay. It comes out of your death benefit. So if you want to go buy whole life, you're more than welcome to do so. Now, granted, there are use cases for whole life, like people who are medically uninsurable elsewhere. Like if you have HIV or AIDS or some type of terminal illness, only type of insurance you'll be able to get is whole life. Or if you're just like 70, 80 years old and, you know, final expense insurance and Colonial Penn is your only last saving grace, then you have to buy whole life because the other policies won't be feasible for you. So the second type of policy is IULs, or universal life. Now this right here, the TikTok bull jive, the infinite banking hacks, all the TikToks and all the Instagram and all the stuff on social media, you know, where they talk about, if you want to have an infinite banking hack, or you want to be able to use your money and you become your own bank and all this stuff. Let me explain to you how these policies work and why they're pushing this so hard. Number one, IULs or universal life policies are funded with lots and lots of cash, right? Now you can pay you know, 500, 600, 700 a month to fund it, or more. But most of the time, people fund these things with massive amounts of money a month, like 30, 40, 50, 60,000 a month, right? Or they just put in like 2 million at one time, or like 500 or 600,000 at one time, and just, you know, let it sit. Now, I'm going to talk about some problems with IULs in a minute. Number one is, like I just said, the commissions are stupid crazy. Like, they're really high. That's why everybody's pushing them, because they love selling those things, because the commissions are ridiculous, even more so than even whole life. So, but what they are, let's talk about what they are. So they are savings combined with ART insurance, or otherwise known as annual renewable term. What is annual renewable term? Well, it's term that renews every year based on your attained age or your current age. So let's say you buy a universal life policy at age 45, and then you turn 46. Well, your premiums are going to go up at 46 because you're a year older, right? Stands to reason. But inherently, this is a problem, because you see, the older you are, the more your mortality cost goes up. And once your mortality starts to eat it, well, we'll get into that part later, but you'll start to see what's going to happen in a minute. So the savings component, it has a savings component just like our friend whole life over here, except that it's invested differently. So the savings portion in a IUL is invested in much riskier asset classes, like stocks, things like that. Typically, the separate account in IULs and universal life policies acts like a mutual fund in some sense, but more so in a variable life policy. But specifically in universal life, they're invested in other accounts, right? So you get a better rate of return theoretically, but you're also exposed to crazy market conditions. Like, I don't know if you guys know what's happening right now. The market has been going down tremendously. We've had like the worst first half to a year in the last 40, 50 years, right? So if you were invested in a universal life policy, your returns would suffer greatly because you're much more exposed to the market. The other thing is it has flexible premiums, so it's got that going for it. And you might say, well, why would you need flexible premiums? And this is a nice way the agents will sell it to you, because, hey, unlike other types of insurance, you don't have to pay the exact amount. You could pay less. You could pay 25, you could pay 50, or you could pay 100. It just depends on if you're facing financial hardship. Hey, you don't have to come up with the whole amount this month. And that looks attractive, sure. But here's the thing. It's always a gotcha. You know how credit cards work, where if you make the minimum payment, it just keeps piling up and piling up and piling up? And remember earlier when we talked about that annual renewable term? Well, here's where the annual renewable term part of your universal life is going to come back and bite you in the butt. Because your mortality costs go up every year. Let's say you choose the minimum payment, and you're like, oh yeah, I got insurance, right? And you funded your universal life policy with $100,000, and you're like, I'm good. I don't, you know what I mean? I'm rocking and rolling. I'm gonna just pay the minimum payments, keep this thing in force, right? As you get older, it's annual renewable term, so your premiums are going up. But guess what? The difference between your minimum payment and the payment you're supposed to pay to keep the policy in force got to come from somewhere, don't it? Guess where it comes from? The cash value in your account. And guess what happens if you don't get to the actual payment you're supposed to be paying sooner rather than later? As you get older, your mortality costs will erode your cash value until, if you don't pay it the actual amount you're supposed to be paying, your policy will implode. And you'll be stuck with no insurance, because not only is the premium flexible, but the death benefit is too. The death benefit's not guaranteed. In other policies, you buy, the death benefit's flat, stable. But in a universal life policy, your death benefit depends on how much is in your policy and what your monthly premiums are, and the performance of the riskier savings account. So, you got to be careful what you're doing, folks. The other thing is it allows for partial surrenders. Unlike whole life, you can't surrender the policy without paying a whole bunch of fees and having all types of problems, or basically getting rid of your insurance. But with IUL, you can take a little bit of your money out, and you're good. You can do that. That's an advantage of it. But the thing is, though, you're still borrowing your own money at the end of the day. And interest rates are going up, in case you haven't noticed. So it used to be that they could say, oh, well, don't worry about it. Interest rates are only 1%. You're borrowing for like 3, 4, 5%. You're good. Not anymore. You're not. Right? So the other thing too is the benefit versus whole life is that there's an option where you can actually get both your cash value and your death benefit. So that's nice, but it all depends on your policy premiums. If you don't pay the maximum premium and your policy's not funded correctly, it's going to implode, and you're not going to have any life insurance because it'll go to close to zero. So if you're not fully prepared to fund these things and it's not funded correctly, you know what? The only people who should buy these policies are people who have a lot of money, who have funded their retirement in every way imaginable. They're maxed out their 401k at work. They maxed out their Roth IRA. They maxed out their annuities. They maxed out everything else. This is like the last resort for people that have massive liquidity, that are ready to do something with that money within the next 2 to 3 years, who are not middle-aged or old. All right. So if that's you, then this policy would be ideal for you. But the way that it's being sold on TikTok is just driving me crazy as a financial planner. Like, it's just, first of all, like we talked about before, you're not allowed to sell a life insurance policy as an investment. And that is what they're attempting to do. And people are looking at this stuff and they're like, ooh, oh my gosh. No, it's terrible. Stay away from them unless you have 6 figures worth of liquidity that you need to use right now and you don't want to borrow money from a bank, and it's cheaper to do it this way. But understand the risk you're getting into and don't keep your money there long term. Okay? Now, speaking of term, lastly, we got term. So term is only good for a specific period of time. And this is how the agents who sell you whole life or universal life will paint this. They'll say, oh, your insurance is gonna, likely expire when you need it the most, which is technically true, right? But we'll talk about that here in a moment, because term obviously has some drawbacks, but out of the 3, it's the best for most people. So it's pure protection, much cheaper, especially if you buy young and healthy. You must buy insurance sooner rather than later. I cannot overstate that. Don't wait. Get it as young as possible and as healthy as possible, because if something happens to you and you can't qualify medically, your choices become very limited. And we all think that's not going to be us, but we don't know. We don't have a crystal ball. I know I don't, and I know you don't. So with that being said, that's why I'm giving you this information, so you can make a rational decision based on the correct information. All right. So term is cheaper, much cheaper, because especially if you buy young and healthy, right? The downside to term, though, is that it is more expensive the older you buy it, and it becomes prohibitively expensive at certain ages, where it just doesn't make sense to buy a term policy because it's too expensive. And in those cases, you have to go back to whole life. So, and it can possibly expire when you need it the most. Now, if you were just going to buy term from a regular insurance agent, you'd be in trouble because your term would expire and it would just be over, and you'd be like, dang, I don't have any more protection, and the company will send you a letter a year before that happens and say, hey, by the way, you can renew with us. We know it's your 79th birthday, but your 75th birthday, you can renew with us for only $758 a month, right? You don't want that, right? So there is a way to avoid that. And it's kind of like a little life hack that I teach my clients, right? And that is to do this. Buy term and invest the difference. You can avoid the drawbacks of term. So let me explain to you how that works. Because term is cheaper than universal life and whole life, take whatever they would have charged you, right? You take a portion of that and put towards buying your term insurance, and you take the rest of that and go open up a Roth IRA with the knowledge that your term is going to expire. See, here's the thing about term. Your needs for insurance is only because you don't have the money, right or wrong. If you had $2 million liquid sitting, in a money market account or in some investments, what would you need the life insurance for? Because when you die, your family's covered. They're good. You only need the insurance because you don't have the money, right? But what I teach my clients to do is get the coverage while you don't have the money, but also save simultaneously to get the money, so that by the time your term expires, you got the money and more saved up. So you don't need the insurance anymore. So you can let your insurance expire comfortably and still have a peace of mind. Because let me ask you a question. If you come and get a 30-year term and I put you in a Roth IRA, and we're getting 8, 9, 10% a year on average, right? And your Roth IRA invested in mutual funds, right? In 30 years, you're going to have close to $1 million, if not $1.5 million, depending on how much if you're maxing it out or not. The max contribution for this year is $600, right? $600 a month. And you might say, well, I don't have 6 months, but we're using this as an illustration. And part of my job is to help you find as close to that $600 a month. So we got to cut that Netflix subscription. We got to cut that Netflix subscription, because guess what? Your financial future is more important than the Netflix subscription, okay? But that's the subject for another video. Right now, get the cheap term insurance, get a Roth IRA simultaneously, and invest. And the years pass, your Roth IRA goes up, your need for insurance goes down. And by the time your term expires, bam, you got the money in your Roth IRA. And guess what? You don't have to borrow your own money like universal life and whole life, right? You can access it, right? Now, granted, not before 59 and a half, but there are exceptions. Like if you're a first-time home buyer, if you get sick, medical stuff, school, some other things, but we're not here to talk about how those accounts work. That'll be the subject of another video. But the point being is that if you buy term and invest the difference, you don't care if your term is going to expire, because by the time it expires, you'll have the money saved up. It's not rocket science, people. Insurance is not as complicated as, I say that given the benefit of my experience, but to, a working family who just doesn't have the time to look into all this, they're trusting financial or insurance professionals to give them the right recommendations. And oftentimes they don't, because they make a commission. And if I can make 5 times as more selling you a universal life policy as I would selling you term, why would I ever sell you a term policy? And these TikTokers and these social media talking heads and accounts are messing it up. There's going to be new regs if they keep on. And I hope nobody out there with a license is doing that, because, it's against state regs to sell life insurance as an investment, because that's not what it's for. It's for life insurance. If you want pure protection, For the lowest costs per unit, term is the way to go. Buy term and invest the difference. If you don't believe me, go talk to Dave Ramsey, go talk to Susie Orman, look it up in Forbes. Forbes just actually came out with an article talking about this stuff, this TikTok stuff, and how it's no good. These universal life, infinite banking hacks, don't do it. All right. So, and I'm not just saying this stuff as my opinion. When you go get your insurance license, this stuff that I have up here on the screen, this is what they teach you. This is Insurance 101. This is how they all work. So it's not my opinion. It's not conjecture. This is all facts. You can look it up. All right. So when you make a decision to purchase insurance, these are the things you want to consider. And if you're not sure, you can get with me. We can walk it through it. Depending on what your personal situation is, you never want to sell policies. There is no one size fits all approach. It depends on your specific circumstance and suitability. All right. Suitability, suitability, suitability. That is the word of the day, ladies and gentlemen. I want you to take away that word, your personal specific suitability. So that's what I wanted to share with you guys today. I hope that was informative. I hope you guys learned something. And like I said, if you need help making a purchase decision and you need life insurance and you're like, we're kind of confused as to which ones you should get and which ones are for you and what the pros and cons are, I hope this helped you solve that. Get with me. My information is going to be in the link down below, and I'll see you guys next time.